Okay, and we're going to go into strategy number one here. And this is where you can start making money right off the bat. And strategy number one is trading the Ichimoku cloud with seasonal analysis. Now, the first step, we're going to find stocks with very strong seasonality. Okay, and obviously, what's seasonal? Knowing that a stock has moved every year by a certain amount of time, okay, you know when um, that stock moves. So, for example, if a stock has gone up 10 out of the last 10 years in December, we know it has a very strong, high probability, or if it's gone up 9 out of the 10 times in December, that it will do it again this year. Now, how do we find this? We're going to use the Magenta screener, and we're going to go right here into our software, Magenta Traitor. We're going to go to Window, and we're going to go to the screener section. And we're going to build, there's a couple of pre-built screens. So for example, if you go to strategies right here, and you can go to the shared strategies, I shared one that says Vicente Luz screener right here. And you can just copy that strategy, copy it over, and then it's going to be in your strategies. Now, when you go to Window and you go to Screener and you go to Load, okay, and you go to Vicente Luz Screener, I go OK. Now it's automatically on that screen. And what does it look for? This looks for stocks with good seasonality area, means stocks that go up in the next 60 days, go up because direction is positive, greater than 12%. So stocks that have historically gone up more than 12% in the next 60 days. We're in November 6, 2013, so stocks that go up in the next 60 days historically. I want the stock to have at least 5 years. I want it for there to be options. The exchange in the U.S. market, depends which market you trade here. The win percentage, I want it that has done it 90% of the time here. And then price, okay, I want it to be above $5 and above. I don't like those low penny stocks, especially for seasonal trend. I want it to trade the volume more than 400 shares. Seasonality, the correlation right here, and the option open interest over 100 contracts, and then I'll search. Okay. And it's going to come up with a list. We have 342 stocks that meet that criteria. Now, what can I do? I can increase this to shorten the list, maybe 15%. And I could put this up to 75 and search. And you can see I cut it down significantly to 219 stocks. So now what have I just found? You can see all these stocks historically go up in November and December more than 15%, and they've done it 75% of the time. Means out of the last 10 years, they've done it 8 times, for example. That's 80%. They've done it 9 times, 90%. They've done it. So if it does it 90% of the time, there's a good probability that it will do it again this time. Okay, so that's the first step. With that, we're already putting the probability on our favor. Now, when I add, that's step number one. Now, step number two, okay, we're going to use what's called the Ichimoku cloud here. Okay, and Ichimoku is a purpose-built trend trading charting system that has been successfully used in the years in every tradable market. You can use it on stocks, on currencies, on the futures market, and it is unique in many ways, but it's the primary strength. It is used of multiple data points to give a trader a deeper, more comprehensive view into the price action. This deeper view and the fact that Ichimoku is a very visual system, it enables a trader to filter at a glance the low probability trade setups from the high probability trade setups. We're already having high probability with the seasonal, and now you're adding the Ichimoku system, and you're going to find very effective trades. This is going to boost your trading winning percentage significantly. You're going to start winning more trades if you follow this system. And a little history. This charting system was developed by a Chinese newspaperman called Goichi Hosada, and he began developing the system before the World War II, and with the help of students that he hired to run with optimal formulas and scenarios, and how to use this computer simulated backtesting to test a trading system. And the system itself was released to the public in 1968 after more than 20 years of testing. And when Hosada published this book, which included the final version of the system, and Ichimoku Kinko Huyo, I think that's the way it's pronounced, I don't know too much Japanese, has been used extensively in the Asian trading rooms since Hosada published this book, and has been used by successful trading currencies, commodities, futures, stocks. You can use this for anything. Even with the wide popularity in Asia, Ichimoku didn't become apparent in the West until the 1990s. And then, due to the utter lack of information in English on how to use it, it was mostly relegated to the category of another exotic indicator by general trading public. And now, it wasn't until now, the 21st century, where all traders really began to understand the power of this charting system. Okay, and the name Ichimoku, which translates to equilibrium, at a glance describes the system and how it is used as described below. While Ichimoku uses 5 separate lines, and we're going to cover in detail these 5 lines, they are not to be used individually in isolation. You have to use them all together. So this is the whole picture. The 5 lines are going to give you the whole picture of the trend in the market. Thus, a simple look at the Ichimoku chart should provide the Ichimoku practitioner with a nearly immediate understanding of sentiment, momentum, and strength of the trend. And the price is constantly measured or gauged from the perspective of whether it is relative equilibrium or disequilibrium. And Hosada strongly believed that the market was a direct reflection of the human group's dynamics and behavior. He felt that human behavior could be described in terms of constant cyclical movement, both away from and back towards equilibrium in their lives and interactions. And each of these components that made up the Ichimoku provides its own reflection of equilibrium and balance. And let's get into the first line. And the first line is called the Tekken Line, which is also known as the turning line. And it's the highest, the formula, you don't have to know the formula, but if you want to understand it, it's the highest price plus the lowest price divided by 2 in the last 9 periods. Okay? Now, while many compare the Tekken line to a 9-period simple moving average, it is quite different in the sense that it measures the average highest price and lowest price. It doesn't measure each price like a simple moving average for the last 9 periods. And Hosada believed that using the average of price extremes over a given time period was better than the measure of equilibrium than merely using an average or a closing price. And this study of Tekken will provide us with the first foray in the key aspect that is prevalent in this system. Okay, and we're going to show you in the Magenta Traitor how can you use this. Now, it can also be used, okay, and it provides as a support. With one exception, that price stayed over above the Tekken in the 3 highlighted areas of the chart, while price broke the SMA numerous times. Okay, so if I go back here, you can see how price stayed over, okay, the Tekken line, but in the smooth, it really went backward and forward. So you see it's a very good support area. So you can see people are using more the 9 Tekken line than the simple moving average. Okay, and this is due to the more conservative manner in which the Tekken line is calculated, which makes it less reactive to small price movements. And on the bearish chart, will act as a resistance level. The angle of the Tekken line can also give us an idea of the relative movement of the price movement in the last 9 periods. A steep angled Tekken line will indicate a nearly vertical price rise over a short period of time or strong momentum, right? Where a flatter Tekken line will indicate a lower momentum or no momentum over that same time period. Okay. Now the Tekken and keygen both measure short term. Of the two, the Tekken is the fastest, and it gives the measurement over the last 9 periods. The keygen, which we're going to get into, gives you over 26 periods. Thus, given a very short term nature of the Tekken, is not as a reliable indicator of trend as the many other components that are better indicators inside the Ichimoku system. Nevertheless, price breaching the Tekken line can give you an indication of a trend change. Okay, and like all Ichimoku signals, this should be confirmed by the other Ichimoku components. You never want to go just with one component. That's why it has 5 different components. So let's go into the second line, which we briefly talked about, which is called the keygen line. And the keygen, and I'll just call it the keygen, they had the sun, is one of the true workhorses of the Ichimoku system. Like its brother, the Tekken, the keygen measures the average price and the highest and lowest through the last 26 periods, which is different from the Tekken, which measures 9 periods. And the Tekken provides us with the information that the Tekken does, just on a longer time frame. It provides the same information, just on a longer time frame here. And you can see the Tekken. So let's get into Magenta right here. Let me just exit out of the PowerPoint right here. And you want to get any of these stocks, right? We'll go one by one right here. And we could pull up some stocks here. Okay. And then on the style right here, you want to go and place the cloud. Okay. And I'll go right here, and it builds the whole cloud system here. Now, when you go right here on the blue line, that's the Tekken line. That's the 9 period line. And this red line is the keygen line, which is the 26 period timeline. Okay, so we have the 9 period and the 26 period. Now, one of the first things I do is, if I'm going to take a bullish trade here, okay, I want to see that the 9, the Tekken, which is the blue line, is above the red line. Okay, so I want to see the blue line above the red line for a bullish trade. For a bearish trade, it would be the opposite. I'd want to see, like back here, the blue line below the red line, because the blue line is the Tekken line. Okay, so let's continue here learning about this system. Okay, and let me go back here. We were going into the third line right here, which it's the Chico Span. And the Chico Span measures the current closing price time shifted backwards into the past 26 period. And the Chico Span represents one of the most unique features, that of the time shifting certain lines backwards or forwards. And you're going to see that in different components that they time shifted backwards or forward. In the Chico's case, the current is time shifted backwards by 26 periods. While the rationale behind this may first appear confusing, it becomes very clear once we consider that it allows us to see how today's price action, or where the price is today compared to where it's 26 days ago or 26 periods ago. If the current price okay, is lower than the price of 26 periods, that would indicate there's a potential for a more bearish price action to come, since the price tends to be following trend. And conversely, if the closing price is above the 26 periods ago, that would indicate the possibility of a more bullish trend to follow here. Okay, so let's get into magenta right here. And the magenta colored line right here, okay, that's what's the Chico Span. And you can see what it's doing. It's measuring the area, the price where it's at today, which is right here, okay, near $21, and it's hovering above the price 26 days ago, okay, and that's right there showing us if it's in a bullish trend. So for example, today's price, which is where the line is above where the price was, because 26 days ago it was at $19, $19.50. Today is at $20.76, so it's tending to trend to the upside here. So that's another confirmation showing us that the price is heading to the upside right there. Okay. Now let's get into we saw Chico Span. Now let's get into Seco Span, which is the fourth line. And this is the first leading line. And the formula takes the Tekken plus the keygen line, divides it by 2, and then in this case it time shifts it forward 26 periods. And Seco Span A is the best known for its part, along with Seco Span B, in forming the Kumo, or the cloud. And this is where the name comes from, the Ichimoku cloud. That is the foundation of the Ichimoku charting system. And the Seco Span A is another of those time shifted that are unique to the Ichimoku, in the case that it's time shifted forward by 26 periods. And since it represents the average Tekken and keygen line, the Seco Span A itself is a measure of equilibrium. And Goichi Hasada knew well that price tends to respect prior support and resistance levels, and this is going to be a very strong support and resistance level. So by time shifting it forward by 26 period, he allowed the Ichimoku practitioner to quickly see at a glance where the support and resistance from 26 periods ago, 1 month ago on a daily chart, reside compared to the current price action. Well, it offers a potential to trade off a Seco A and B line on their own. The real power comes with the dynamics of the Kumo system. Let's take a look at Seco Span B, and this is the second leading line, and it takes the highest plus the lowest, divides it by 2 for the past 52 periods, and it time shifts it forward into the future 26 periods. Now the Seco Span is best known for its part, along with the Seco Span A, for forming the Kumo, as we learned. Now on its own, the Seco Span B represents the longer term view of equilibrium in the Ichimoku Huyo system. Rather than considering only the last 26 periods, Seco Span B takes the average of the highest and the lowest over the last 52 periods. It then takes that measure and time shifts it forwards by 26 periods, just like Seco Span A. In Hosada's original implementation, the Seco Span B was thus, represent price and equilibrium for the prior 2 months, shifting ahead the current price by 1 month. This convention allows the Ichimoku practitioner to see this long-term measure of equilibrium ahead of the current price action, allowing them to make more informed decisions here. So let's take a look right here, and we'll go in, and This is Seco Span A, and this is Seco Span B right here. Okay, Seco Span A and Seco Span B. And you can see how the price is right here, and it's time shifted forward 26 periods. Now, this area, when A is above B, the cloud has a bullish color. Okay? Has a very nice bullish color, or green color here, to indicate a bullish trend here. Now, when A is below B, okay, the cloud color, because basically the cloud, or what's called the kumo, is the space. It's filled in the space in between A and B. Okay. Now, one of my favorite strategies comes in. So I always want to look at right here and confirm that we're in a bullish. So for example, right here, this is bullish. Okay, the cloud A is above B, and the cloud is bullish. Right here, we can see that the Tekken is above the keygen, blue above red. That's also bullish. And the Chico Span is also bullish. Obviously, we see seasonality is bullish. This is the yellow line. This is showing that this is the time of the year that this stock tends to start heading upward. Okay. Now, when do I want to get in? One of my favorite strategies using this system is what I call the breakout, or the cloud break strategy. I want to get in when the price crosses. You can see how here it got into the cloud. I don't want to trade inside the cloud. I want to get in right when it breaks this cloud right here. So when it exits the cloud here. And let's see some examples of some trades that I've taken recently. For example, Joy was one. We made some nice money with Joy. Okay, you can see right when it broke out of the cloud, right back here, near $53, and then it really drove up all the way to $57, and it continues bullish. You see, it has stayed above the Tekken. So as long as it stays above the Tekken, it's still in a bullish trade here. Okay. Let's look at Walter Energy right here. There's another one that I took recently. Okay, and let me go right here to the cloud. Okay, and you can see right back here, it got out of the cloud. It went sideways for a little bit, and then it started moving up nicely from $14 all the way to $18. We can see Apple. I mean, I've been able to make money on Apple on both directions, when it goes up and when it goes to the downside. For example, let's take a look right here. Look how Apple, it alerted me when to get in to the downside. Here was the same concept, you just flip everything around. If you're taking a bearish trade or a put trade with options, when it breaks with a bear candle, which is the red candles, to the downside, right there you have a nice bear trade. And you can see the cloud was bearish, red color. Right here, the Chico Span was below the candles. Okay, the blue was below the red, so the Tekken was below the keygen. And you can see how it moved down real nice here. Okay, now when did it tell us to get in? Okay, kept on going down, 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 and then right here it broke out of the cloud to the upside, where we made money now going to the upside. So this is a very powerful strategy. We just find the best time of the year, another break out of the cloud, went in the cloud, bounced, and continued moving forward. So this is a real good trading strategy to show you when to get in. For example, Google. Okay, a lot of people are saying when to get in on Google. And let's take a look here about a year ago. And you can see right here, broke out of the cloud, continued moving up. Right here, broke out of the cloud, moved up. Okay, if we take a look at, for example, this one, LVS. Okay? and I go right here to the cloud. This is a recent trade, had good seasonality. This is the time of the year that it goes up, and it broke out of the cloud. And you can see how it came down, bounced on the cloud, gave you a bull candle, and the stock was at 58, and now it's at 70. So you made some money, and the cloud's telling you it's bullish. Okay, so you're always trading on the direction. I also use this for the indexes to tell me should I trade more calls than puts. Okay, and I go right here to the cloud, and you can see right here, look at the trade. As long as we're above there, I'm bullish and I'm trading more calls. Now this one alone made me a fortune on 2008 when everybody was losing money. I was making a ton of money knowing when to get in, and I'm going to show you guys right here. Let's just highlight this area right there. Okay, and look at 2008 right here. It told me to start getting bearish. Then right here it told me to get bear. Right here it told me to continue bearish. All 2008. This was July right here when everything was starting to come down. And people were still trying to go to the up. I knew people who were saying, no, it's going to come back. And I say, I'm not buying until it breaks the cloud. And it didn't break it till May or April 2009. Here's where it told me now the market's turning bullish. This strategy by itself, I've shown it to so many people, and a lot of the first reaction is it would have saved me so much money. Not only saved me money in 2008 from the people who lost, you would have been profiting if you would have known this strategy in 2008. But the nice thing, now you know it, you're going to be able to implement it and start making money with it. And feel free to leave comments, email me any comments. I want to hear your feedback. Feel free to leave comments under this video. Look forward to showing you the next strategy on the next video.